Hello and welcome back. This is DruVision IT Consulting. It is September 2023. We're rocking Casual Fridays. So I've been thinking about what to do for this one for a little while. And I thought about let's talk about something that is near and dear to my heart. And that is, of course, IBM, right? And I started at IBM August 21st, 2000, right? Many, many moons ago. So wanted to talk about the brand, its transformation over time, and candidly, what some people see as the decline of the brand. Wanted to go into how is that reflected with the Kantar ratings. I wanted to go into their revenue, net income over time as well, and then go into six of my reasons why. I'll be giving public information, insider information, none of it confidential. Of course, this all has to do with my point of view, but I think at the very least, you'll find it informative, entertaining, and get a little bit better sense of who the company is today and maybe a couple of things that they could do about it to turn things around. With that, this is DruVision IT Consulting. Please hit like and subscribe, and I hope you like the video. Let's dive right into it. Okay, so as I just stated, IBM has been a huge part of my life, my history. I've been on awards trips. I've seen places with my family that I never would have seen otherwise. Whether it was Hawaii, Bahamas, Dominican Republic, which is my new favorite, home away from home. I've been there five, six times now with the family. Absolutely love the people there, the culture, and just getting away from it all for a little bit. If you've never been, you really got to go. Your dollar goes a very long way there. You will not be disappointed in the Dominican Republic. So, and to be very clear, I wouldn't be talking about the decline of this classic American brand. It's over 100 years old. It's been around. It's contributed to the world that we know, right? Even to this day, the vast, vast, vast majority of every single plane ticket you buy, banking transaction that you undergo, financial stock trade, etc., uses their technology that they built up with their tremendous intellectual property over the years. It is an amazing company with amazing people and some of the best leaders whom I respect personally that have ever been. That said, there's some obvious areas for improvement, right? And you don't take my word for it. Go to Seeking Alpha, Forbes, Fortune, etc. There's all kinds of much smarter people than me who do nothing but sit there and digest 10K reports and dissect what companies need to do. So I would encourage you go research those if you're considering buying or selling IBM stock. It's a dividend stock. It's pretty hard to go wrong with that. It has historically performed okay, right? Consistent with market is what I would say about that. So let's get into brand. What does that really mean? Right? Brand is candidly a function, and it depends. There's Interbrand, there's Kantar, there's a number of different brand metrics, right, out there. I've chosen for the purpose of this video Kantar, but there's a number of other ones, right? And you can slice and dice and question the data all that you want. But I think this is a pretty good one, and it's a baseline for us to use for this video. Brand is what do people think about your company over and above the revenue and profit, the financial performance of the company, right? What is its brand recognition? Like who's ever heard of it? How many people are exposed to it? How many people are willing to continue buying from that brand? And so, as we'll see in the next few slides as we go into it, there's some obvious factors, financial performance being one of them, as to why the brand value has dropped over time. Because most of these equations, right, Kantar, Interbrand, et cetera, they use overall company financial performance as a derivative of some of these other factors, right? So it's the aforementioned recognition, et cetera, plus the financial performance. So obviously, if one of these factors goes down, the overall brand is going to go down, right? Probably not the most eloquently said, but I think you could take that away in a nutshell. So let's have a look at it. And because the brand is a ranking from 1 to infinity, as many companies as there are, I had to do this on a scale of 100. So just to be very clear, right, 100, that number up there represents number one, right? That would be the number one brand ranked company, whether it was Amazon, Google, Apple, et cetera, over a particular period of time. So as you can see here, this chart actually starts in 2007. It concludes in 2023. And this is using Kantar data from Wikipedia, right? That's where I got it from. Obviously, Wikipedia is either populated by a Kantar or someone else. I didn't look at the particular notes, but that's the source for these particular numbers. You can look those up on Google, Microsoft, etc. What you're going to notice is there's a big bulge in the middle of the screen, right? And that represents really 2011 and 12, the height of, I'll call it just the IBM hegemony, right? That's when they were at their biggest by revenue and profit by dollars, maybe not as a percent of revenue, but they were huge, gigantic. And then what you watch is a relatively slow decline over time. All right. You'll also happen to notice that this particular chart follows the revenue and net income that we're going to see on this slide right here. And it's a little bit hard to see. This chart actually starts in 2005. It's from Days Info. Thanks to them, I print screened this to put into here. What is most notable here, and it's hard to tell, is that red, orange, I'm blind, so I don't know what the hell color that is. You tell me in the comments below. Um, it gets smaller and smaller and smaller. As a percent of revenue, it does to an extent get larger, which isn't depicted here. But in terms of overall raw dollars, right? And so, depending on your definition of the purpose of a company, which some would argue is to bring enrichment to the members of the company as well as its owners, in terms of total profit dollars, is actually less than what it used to be. At its height in 2012, it was $8.5 billion of net income, right? And net income is different than gross profit because it's after, earnings, interest, tax, depreciation, et cetera, right? So it's after you pay all your taxes, your employees, your bills, your write downs from laying people off the year before, that's what's left. This number today is less than half of what it used to be. And it's up to you to decide whether you think that is good or if you think that is bad, or maybe you have no emotional attachment to it at all. You're like, what the hell? So, what I want to go into is some of the reasons why I think that's the case. And so, my top 6 reasons why do I think this brand has done that? And here's where the long winded storytelling of this episode really and truly begins. And it really starts with ownership. And the ownership journey for IBM, it's a 100-year-old company. It's been publicly traded on the New York Stock Exchange forever. And people have come, people have gone. But what we saw throughout the early 2000s was the consolidation by institutional investors, right? And if you're wondering what an institutional investor is, those are your big money firms, right? Whether it's Merrill Lynch, that might be considered one. But traditionally, in this sense, we think about BlackRock, State Street, Vanguard, etc. And what gave these companies the cash to do that throughout the early 2000s and to continue consolidate their power up to and including today is the 401k programs, right? 401k stock investment programs. As it became cheaper and cheaper for people to invest, they would do things like get the Vanguard market fund, right? And you can put your money into this fund and it's going to outperform inflation by 2 to 5%, depending on the year over year over year over year. And of course, that's an attractive investment, right? So you're going to make if inflation is 2 to 5%, and it's earning 7 to 8%, that's a good return on your money, right? So more and more and more people started doing this, which of course gave more and more cash to these companies to buy more and more stocks from publicly traded companies. So their ownership stake would increase over time. But why am I going into all this detail about how these companies like BlackRock, et cetera, gained all of this power? Well, it's important to understand why they are, like in the case of BlackRock, they are IBM's largest owner. And so people may recall that Lou Gerstner, he's the one who Elephants Can't Dance. He wrote the book about turning around IBM in 1993. He was the CEO when I was hired in 2000. He exited the business, I want to say 2001, 2002. He retired, right? He maintained a supervisory role, kind of, consulting, et cetera, helping out Sam Palmisano, who took over the reins. Now, something important to understand about Lou and to understand about Sam and the history of IBM. So IBM began as an engineering company. It transformed under, I think, Watson Jr. started to transition into a sales company, right? Where it remained until Sam Palmisano, where it started to turn into a finance company. And I'll explain what that means in just a minute. So Sam Palmisano was a career sales guy. He's a sales guy through and through and through. To my knowledge, I don't think he spent any time in finance, but he was always a big deal sales guy. In one of my roles, taking over troubled and broken accounts, he actually negotiated the deal that was troubled and broken, right? Do you want to say it's his fault? Arguably, it was, right? Depending on your point of view and who you asked. But he was a sales guy. And by this point, BlackRock was far and away the largest shareholder, of course, with the other six primary owners. Again, all of these money management firms owned IBM, right? And of course, there's billions of shares outstanding, yada, yada. And our total market cap was ginormous, et cetera. But he committed to, in agreement with them, he agreed to do a couple of things. Number one, he agreed to meet with them every month to talk about what performance did IBM need to deliver to the owners. Okay, these are private meetings, bear in mind. These are not investor, publicly traded, public forum meetings. These were private, meeting with them. So that was one thing that he agreed to do. And I'll explain why that's bad in just a moment. The second thing that he did is he agreed to something called Roadmap 2015. And what that was an earnings per share commitment year by year by year by year to increase that number going up. So with that simple concept in mind, I've got to deliver a certain number or amount of earnings every single year. I'm committed to it. He said he would do it. He didn't actually give up on that plan, I think, until it was 2013 or 2014, right before Ginny Rometty came in. And it might have, in fact, been part of his undoing. I can't vouch for that. I don't know. I certainly wasn't high enough ranking at IBM to have been in those meetings. But that said, there's a couple of ways you can influence earnings per share, right? And this is not a finance lesson. I can improve my revenue and my profit with it as a fixed percent of revenue. I can grow my profit as a percent. I can reduce the total number of shares into which my earnings are divided, which is really the crux of this problem and why this whole downturn in the brand and the revenue and net income exists. Rather than grow the company anymore, because they decided that IBM was already number one. There was no up. They decided rather than organic growth, they would actually start to seek out more of the Microsoft model. Microsoft was literally the prototype they wanted to follow. They wanted to have that 45, 55, 65% gross profit range, right? And at the time, with all the hardware that was in the mix of the business, they were floating around 25 to 30. right? Not bad considering they're selling commodity hardware, things like PCs, desktops, laptops, etc. Um, but not where they wanted to be. So began selling off the individual businesses. First, it was the desktop laptop business to Lenovo. Later came the X series servers. Um, they sold off pieces of the storage business. So NetApp today is largely a function of the prior IP-based storage that we sold off to them. Much of Cisco is comprised, this was a little bit earlier than Roadmap 2015. Much of Cisco today is comprised of the IBM's former networking division. They sold these pieces off little bit by little bit by little bit. And in one of my later points, we'll talk about how that's a little bit ironic. But the point here is the ownership decided IBM needed to get smaller and more profitable. Strategy. So strategy is a function of ownership, right? All of the things that follow are, in fact, a function of ownership. Your owners dictate to the business what they are going to do. You think the CEO has the power? They don't. They are much like a president in the United States, more of a figurehead, more of a mouthpiece, but they're executing what the government, in that case, needs to be done, right? Sure, they put their pen on paper, but they're signing what they've been told to sign, right? Um, so the strategy is a function of ownership. So at this point, the business has decided we're going to get smaller and we're going to sell off some of our businesses. And when it comes to this, is a key component of recognition, right? There was a B2C component when there was an IBM personal computing division. ThinkPad, everybody knew it. Everybody bought one for their kid to go to college, right? It was an esteemed laptop in law offices around the country. Um, the x86 servers, right? So then called the X series servers. Before that, they were called Netfinity, System X. They had a bunch of different names over time. Um, they got rid of these businesses, and with it, they got rid of their exposure. They also got rid of, in the TSS division of IBM, the technical support specialists, the people going and touching those small and medium business clients. That was their IBM account manager. That was their rep, the guy who shows up and fixes their PCs or their I-Series server, their P-Series server that's been sitting in a closet, unattended, hell, sometimes unknown for 20 straight years without breaking. This is quality engineering at its best. But as they started to spin these things away and get rid of these account managers, these TSS um, resources who fix these things, so too went with it their brand recognition. People lost their IBM touch point. They lost their contact. I guess they're supposed to watch an NFL Super Bowl ad and know who IBM is. But as this started to go away, so too with it did go the brand. And I just mentioned I series and P series and this outsourced differentiator. So, what do I mean by this? We started to, this would be around 2012. We started to outsource many parts of our engineering to third party companies. Why? Oh, it's cheaper. Bottom line, right? So, earnings per share, remember Roadmap 2015? Same stuff. Drive your cost of goods sold down. Well, how do I do that? Reduce my R&D. It's a function of spend. Okay. Outsourcing to other people. And they would have some of their most respected individual brands like System P or P series, like the P790, P770s. There were massive recalls on the P770s. They were flying people literally around the world to go and fix these, right? They had some backplane issues that were pervasive, right? Across all of them. They would just fail. And guess what? ERP happened to be standardized on P770s across all of IBM. That's right, SAP, right? You better believe SAP was pissed when all of a sudden they realized that the platform that runs their software for tens of thousands of customers is just failing left and right. It was a huge, huge debacle. And it's because they outsource a key differentiator. Another one, and this is somewhat linked to number two, the strategy, cloud strategy. We had none. We missed that boat so clearly. Sam Palmisano had every opportunity to invest in cloud early on. And instead, he decided to the very first version of IBM Cloud wasn't even cloud, right? It was our e-business hosting on demand. We actually had some data centers and we built, oh, what do they call it? The SMB architecture, right? And clients would just host. Is that cloud? No, that's hosting. And honestly, many, many cloud providers are really just offering hosting. It's not by definition actually cloud, even though they may call it as such. So what did he do? He bought other companies to be the cloud for IBM, right? So the very first 2012.1 version of cloud was a company he bought out of Raleigh, North Carolina. Okay. And it was all right. It wasn't bad. We had some institutional clients use it. It was robust. It lasted, but it wasn't really cloud. It was just hosting, right? So we bought that. Then we tried to iterate that. And we're like, holy crap, this is expensive and hard. And we didn't have the cloud foundational knowledge to be able to engineer this in a great way. And he said, shoot, we don't have enough money because we're on roadmap 2015 to actually develop this the right way. So that would have been called what was that 1.3x, and there were multiple versions of that. So they went out and they bought SoftLayer, right, a Dallas-based company, very good architecture at the time, right? So they bought SoftLayer to be their cloud, and this is functionally outsourcing. Rather than make it ourselves, we went out and tried to buy it, and subsequently, upon buying it, we neglected to actually invest in them. Right now, we did go and expand. We spent, I think, Ginny Rometty's the CEO at this point in time, went out and was spending $6 billion a year to build more and more and more SoftLayer data centers. And that's great, but you're standing still. What you weren't doing was revolutionizing the SoftLayer architecture to be contemporary with its peers. And during this same point in time, Amazon, Microsoft, their clouds are leapfrogging us, right? And fundamentally, what that came down to was the pod architecture for IBM was wrong, and the networking components underneath of it, right? We didn't have bring your own IP. We didn't. We sort of had it. Oh, but you can't use this block, this block, this block. It was just, it wasn't user friendly. It performed great. It was robust once you got there, but it was hard to use, right? So these are outsourced differentiators among many things. Signings cancer. So I spent 10 years, over 10 years, in the services arm of IBM. And what does this mean? Right. And again, going back to strategy, going back to ownership. So Lou Gerstner brought with him the services culture to IBM, a great move, saved the company, right? IBM was in the trash bin in 93, 94, right? The PC business had died. Everybody else was doing it better. And what signings is the total contract value of a piece of paper you sign with a client. Over N number of years, you're going to spend M amount of revenue. And let's just say we're going to do a 5-year contract for $10 million. Okay. So that's $2 million a year. This client, you maybe, if you're watching this video and you've worked with IBM before, that's your commitment to spend. And so backlog is the total contract value minus what has already been spent. Simple, right? So if you're in year two, you've already spent 1 year's worth of revenue. So you spent $2 million. The backlog is $8 million. And it's a good internal KPI and indicator for a business because it's a reflection of future revenue and profit. Great. Okay. So what's wrong with it? What's wrong with it is sales is paid on it, but they're not actually measured on how these contracts deliver revenue and profit. And many of the roles over time, and this changed depending on the year, how sellers were compensated has changed. But it used to be they were only paid on how much they signed. Go sign, 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 sign. And of course, price is a component of any signings, whether or not a client's going to sign. So they would sign deals. Oh, well, we can beat that price. Okay, but you have cost to deliver. Can you deliver at the value that you sign with the client? Excuse me. Good question. And so what would happen is the sales culture would sign these deals that oftentimes there were solution misses, like they just didn't understand what the client wanted IBM to do. The client might have been difficult to deal with, a whole host of factors. But the net result is they weren't able to deliver. And guess what? When you can't deliver on a contract within the price point agreed, you're going to soil your brand. Your brand reputation is going to take a hit. And this happened with $1 billion contracts, $100 million contracts, and $1 million contracts over and over again. I'm not saying every time. We had a lot of great contracts with a lot of amazing clients that delivered tangible outcomes, did exactly what they said they were supposed to do. But there was way too many bad signings, right? Bad contracts, contracts that hell. I used to have a job to try and turn around bad contracts, right? Signings cancer, one of which I just mentioned was negotiated by the former CEO, Sam Palmisano. It was horrible. Why? That's your name. That's your commitment to a client to do something in the right way. And it really just made an indelible imprint on the way that I feel about your word. It is so important in business. You have to do what you say you're going to do, right? Sometimes bad things happen. You've got to deal with it. You can't just walk away from a client. You can't just say, oh, we're leaving, right? You can't do that. So that's what signings cancer is. A lot of bad deals added up over 25 years, 25, 30 years. A lot of people have been burned. It used to be people said nobody ever got fired for hiring IBM. That's no longer true today. And it's unfortunate. It's sad. And I wish I could have gone to all of those contracts and fixed them. So what's number five? Execution. Execution. This number five fits squarely in the Kodak camp. You may be like, Kodak, what the hell are you talking about? Kodak didn't execute when digital came around. They split their resources and they could never really commit to film. They could never really commit to digital. They didn't know what to do. They had a lack of direction. They just kind of meandered, right? Execution is making sure that your bureaucracies don't get in the way of doing simple, ordinary tasks that deliver outcomes for clients. Execution is um, managing in a cohesive, unified way your brands, what they do. Simple case in point. Why was NetApp way more successful with IBM's storage brand than we were? Why did Apple take the iPad from the Transnote and turn it into $1 billion enterprise? Just the iPad. I mean, IBM probably sold 20,000 Transnotes, 50 at most. How many millions of iPads have been sold? Right? Not that they bought it from us, but we never executed on a great idea. It was an awesome idea. We invented it, but we didn't execute. Um, Wise. Was it Wise? Might have been their competitor. I'm having a senior moment. Um, we used to have a thin client business. We were horrible at marketing it. We sold very, very few of those. We sold off the business, and all of a sudden, boom, huge thin client business, right, with another company. This has happened again and again and again. Why? It's just a failure to launch. It's a failure to invest. It's a failure to have the right leadership. Why does everybody else do better with our products and services than we do? Is it because we do too many things, or are we underinvesting in our businesses? You could ask about that, right? Between 2012 and 2016, we did massive billions and billions of dollars of share buybacks. Billions of dollars. Why? It increased the earnings per share. Why? Because it reduces the numerator, the total number of outstanding shares, right? What would that money have done for the business? Maybe we could have invested engineers to make a better cloud platform. Maybe we could have advanced our software portfolio to be easier to use, more marketable, to deliver better outcomes for our clients. But instead, no, we improved earnings per share, which again goes right back to ownership. It was poor investments, poor return on investment for IBM customers. Is it great for shareholders? Sure, I guess. You tell me. That's up for you to decide. But it didn't help the business grow. It didn't help us innovate. It didn't help us do anything new. Okay, you might argue, oh, but IBM has always had, 6% of revenue invested into R&D. Okay, and we've won the patent award for what, 30, 40, 50 years straight? Great. What's it doing now? The company's just getting smaller. It's not making nearly enough money off of its intellectual property. We'll see in the future. Maybe it will someday, but it's not right now. You can go read it. Read it in the 10K report. It's not helping. So I ask you, were those billions of dollars of share buybacks the best way to execute on the business? I would argue no. All right, and lastly, number 6. Sorry for the rough edit. Something happened with the computer there. I'm not reshooting this whole thing. Brand definition. IBM believed, as many companies do, they're not alone in this, that the brand was bigger than its people. And consequently, they were okay with moving people around all the time, right? Changing coverage models and strategies. And I get it. That's optimizing. That's trying to figure out how to deliver more value for your clients, your investors, etc. The problem with that is, by my definition of brand, your brand is the grand total of your people and the value they deliver, right? It's the people doing that. Your brand isn't bigger than the sum total of the good work that your resources do, right? You've got these relationships forged, blood, sweat, and tears together, IBMers and clients side by side. You're creating these outcomes, and then you just switch them all around. Well, the clients will stay with IBM because they have a contract, right? They have a product that they're invested in. Do you think that helps? Do you think they're committed to the next guy or girl? Do you think when you send 20, 30, 40,000 jobs from the United States who have these decades long relationships with their clients over to India, that the Indian people are going to be able to pick up right away, right where the people who've been there for 10, 20 years have left off? This isn't about whether India is better or worse than the United States. Nothing to do with that at all. It has to do with breaking of relationships. Relationships and commitments matter. And when you change people, those commitments change. Are they invested in the outcome? Maybe, maybe not. But just simply being IBMers doesn't mean that, right? And so when you create these unnatural disruptions, it can be a big problem. And so what we have watched time and time again is accounts struggle, right? Transitions are hard. That's change management. That's hard to do with an existing team, let alone a brand new one that has to come in and be taught by the people who are exiting the business. That's not great. And so do that enough times, more and more clients get upset. Why? Because their outcomes don't get delivered, right? There's new people that they're not invested in. And I get it, invested in the brand. The brand is bigger than people. I understand the point of view. I don't agree with it. And I think that is the last of my reasons why the IBM, an iconic, amazing brand, has declined over the last 20 years. Would I love to see happen? I'd love to see them right the ship. I'd love to see the CEO take more institutional control of the company and what it does, rather than reverse engineering financials, right, to meet some arbitrary, uh, I don't know, value metric, right? Revenue per employee, KPI, or whatever, right? I get it. Those things are important in running a business, but sometimes you have to invest in the long haul. Invest in your clients. And how do you do that? By investing in value that you can create for them. I'd love to see them do a lot more of it. But that said, on a parting note, I'm optimistic. I am, bullish on IBM. I do think Arvind is gotten his feet wet now. I think he's going to start making some positive changes. So fingers crossed. I'd love to see IBM turn it around rather than continue this downward slide. That said, thanks from DruVision. Click like and subscribe. Thanks for listening.